Picture this, the AI race is not a sprint, it is a marathon and someone just slammed their fist on the table. Ives of 𝗗𝗟𝗏 just did exactly that when he called Meta a table pounder and warned that the AI arms race is only beginning. First I'll play the clip of Ives on CNBC closing bell, then I'll give you my full reaction and a deep dive into everything he said. After that I'll walk you through 2 great tech stocks to buy now and hold for the long run. If you only watch one video today, make this the one, and watch all the way to the end. Smash that like button, help us hit 1,000 likes on this one, share the video, and drop your thoughts in the comments below. Subscribe so you do not miss the next important investing update. Alright, let us hear what Ives has to say.
Ives is 𝗗𝗟𝗏𝗧's global head of technology research. He joins us now. Dan, great to have you with us.
Great to be here.
We mentioned some of those names, the high flyers, Oracle, the Palantir, AMD. I want to go to Meta, though, because Meta seems to be an interesting sort of example of this question that investors are really asking themselves in terms of what they're getting for that AI spend, the prognostication of we're going to spend a lot of money and it's time to spend money because we've got to seize the opportunity. But they're not really giving investors a roadmap as to how they're going to reap the returns on this investment. Is Meta an outlier, or is this going to be the example that we look back on and think the whole sector is going to be held to this standard at some point?
Look, I think Meta is a bit of an outlier just because, obviously how dramatically more they're going to spend on CapEx and what happened to numbers going into next year. But in my opinion, Meta's a table pounder here, and I think below 600, because it's my view, they're transforming this business over the coming years. Zuckerberg right now, wartime CEO. I get, fretting about everything that's happening here, but this is an AI arms race. And I continue to view it as you want to see them spend because you're talking about the earnings growth over the coming years is going to be massive. That's why they're spending.
Dan, it's Karen. Thanks for being on. Thanks for wearing that outfit. It's always good to see what you're wearing. So Great. Meta, which is a big position for me, so it's been a painful, week or two. The promise of what the spend is, we know that their business, that they've been able to use AI in their business, and the product that they're able to deliver to advertisers has really that's working. But the part that we don't know is the llama spend, and we do know they get some revenue sharing. Maybe you could tell me how significant that is. But that's still a big question mark. What do you think the return on this, whatever they're going to spend, $100+ billion next year, what does it need to be?
Look, I think the return ultimately is going to be multiples of what they're spending over the coming years because they're going to change their whole advertising model. You look at the monetization of 3 billion users, that's what they're focused on. And I think that is the smart move because the Meta today is going to be a whole different Meta over the coming years. Even when you look at the further monetization that you're going to see from the hardware perspective and software, they're building out a new ecosystem. And I think that's where, of course, the winners, the clear ones, NVIDIA, AMD, chip makers, everyone else. But you look what's happened in Microsoft here, I think that it's another table pounder under 500 because in my view, the enterprise backyard will be Redmond's. And this is one where I think the market is sort of misread or maybe nervousness in terms of what we're seeing. Dan,
you're pounding a lot of tables. In fact, the kitchen shaking or the dining room shaking. The one in your notes that, I'm most interested in hearing about is maybe not surprising to people that watch our show, is Apple. And you've come kind of 2 or 3 different visits to us from being very concerned about that moment and act fast. And you turned to being bullish last time and now seemingly more bullish. Explain that. I'm pounding the table on the hoodie as well.
It's great to see the table pound. And part of it, but even just taking a step back, is that it's my view we're still in the second inning, maybe third inning of AI revolution, right? So that's why I continue to view these tech names where they're heading. When it goes to Apple, look, the whole thing that changed once Google won the DOJ suit, that opened what I believe the yellow brick road for Apple to go aggressive Google Gemini on the AI partnership. And I think that's really the consumer AI revolution is going to go through Apple. That's $75 to $100 per share as it all plays out. Then iPhone 17 being the surprise upgrade cycle, numbers will continue to go higher. And it goes back 6 months ago, New York City cab drivers bearish in Apple. And that continues to be the name you want to own.
When does a shakeout happen, Dan, in these names? I mean, if you look back at the internet boom, there were companies that participated in the boom and then got shaken out when things sort of rationalized. Are we going to see that moment in this boom, or is it just pound the table, pound the table, pound the table? It just doesn't seem, no, right?
No, I think you're gonna see the shake. I mean, the shakeout's gonna be clear because you could say AI 15 times in a conference call. It doesn't make it an AI name. It needs to be execution. Palantir will sell off, but you look at those numbers, that was a masterpiece quarter in terms of everything that they're executing on. Companies that don't execute, you see these are stocks that will be down 30, 40%. I think 2026 is going to separate the winners. We talk about the AI winners from what could be the losers or the fakes. And I think that's the opportunity. It's a stock picker's market when it comes to AI. I think that's really the theme here.
So to kick things off, Dan lays out the broad view. We're still very much in the early innings of the AI revolution. He believes tech stocks have runway ahead of them into year-end and beyond. He argues that despite concerns about valuations, the real story is the next wave of capital expenditure, CapEx, and business model transformation driven by AI. He sees the high flyers names like Meta Platforms, Microsoft Corporation, Apple Inc., Palantir Technologies as major players in this shift, but cautions that execution will be key, and not every company will win. When the host brings up Meta, Dan calls it somewhat of an outlier because of how aggressively it's spending on CapEx and how radically it's transforming its business model. He notes that while investors may worry about the huge amounts of money being poured in, e.g. for llama models, for AI infrastructure, his view is that this spending will pay off in multiples, meaning he expects the returns to far exceed the investments over the coming years. He points to Meta's 3 billion user base, its advertising business, and its hardware plus software ecosystem as sources of that payoff. So from Dan's standpoint, Meta is a table pounder, a company he is absolutely pounding the table on. What that means for us, if you believe in Dan's thesis, Meta is not just another tech stock, it's a key lever in the AI arms race. Shifting to Microsoft and Apple, Dan makes some interesting distinctions. For Microsoft, he sees the enterprise AI, cloud, back-end scenario as their backyard. He's bullish because he thinks Microsoft is extremely well positioned in the enterprise realm, and that the market may be underestimating that. For Apple, he actually pivots. Despite past concerns, he's been more cautious about Apple in past visits. He is now more bullish. He thinks Apple is poised to benefit from the consumer side of the AI revolution. He mentions the partnership with Google's Gemini, the potential for surprise upgrades in the iPhone 17 cycle, and the idea that the consumer AI trend will go through Apple. He even quantifies a target, an uplift of something like $75 to $100 per share as this plays out. So for Apple, he's saying, maybe we were too cautious, maybe Apple's about to become a major beneficiary. Now, Dan doesn't say, nothing can go wrong. He explicitly says, a shakeout is coming. He warns that just saying AI a bunch of times in a conference call does not make you an AI winner. He points out that companies that don't execute, while the ones that raise expectations but fail to deliver, could see their stocks fall 30 to 40%. He frames 2026, and arguably the years beyond, as the time when the winners separate from the pretenders. So even in this bullish setup, there is selectivity and risk. This isn't a blanket, buy every tech stock thesis. It's buy the ones with the right execution, portfolio, spending plan, and business transformation. Let's pull this together for my audience. If you took away one major takeaway from Dan's interview, it's this: we are in the AI revolution, not its tail end. The investment opportunity is still large and spans across spending, transformation, hardware, software, cloud, consumer, enterprise. It's broad. But the stakes are high. Companies are making big bets now, expecting big payoffs later. If they deliver, the upside could be huge. If they don't, the downside is material. And crucially, he believes that for companies like Meta, Microsoft, and Apple, the odds of delivering are higher for various strategic reasons. From an investing standpoint, how should you think about this? First, understand the table pounder concept. Dan thinks some companies are worthy of that label, meaning companies he feels very confident in and is willing to bang the table on. If you own or are considering owning such names, think about them as core holdings, long-term bets on the AI transformation. Second, don't just buy any AI or tech name. Examine whether the company has a roadmap, whether its spending is deliberate and tied to future revenue, whether its ecosystem is evolving, hardware, software, cloud, consumer, enterprise. Third, remain aware of the timing. Dan says there is still upside into year-end. He mentions 8 to 10% further upside for tech broadly, and he sees more than just a year of runway. The bull market for tech may have 2 more years of run. That implies not just short-term outlook, but medium-term horizon. Fourth, be wary of the shakeout risk. exposure to failure is real. So, diversification, risk management, understanding individual company execution is essential. Now let's talk about the implications for some of the big names. Dan sees it as aggressively investing, transforming its advertising model, leveraging massive user base, entering hardware plus software ecosystem. For your audience, if you believe this transformation actually happens, Meta could be a high conviction pick. But the risk, the spending is huge. Delivering the returns remains to be fully proven. Microsoft positioned in the enterprise back-end AI race, cloud, infrastructure. Dan believes this gives Microsoft a structural advantage. For you, good pick for exposure to enterprise AI. Apple. The more surprising turnaround in Dan's view. If Apple can use consumer AI, hardware upgrades, partnerships, you might see nice upside. If you've been underweight Apple because of earlier caution, Dan suggests maybe it's worth reconsidering. The broader tech AI set Dan's bullish, but selective. He warns that not all companies will emerge winners. 2026 might be when the pretenders get weeded out. So pick your companies carefully, focus on execution, business model change, strong balance sheets, and credible AI strategy. In closing, I'd say, this interview gives us a roadmap for how to think about tech and AI not just for the next few months, but for the next few years. The excitement is real, the opportunity is large, but the risk of being on the wrong horse is also real. For my audience, if you're allocating to tech AI, make sure your thesis is firm, your time horizon is long, and you're prepared for both upside and potential shakedown. Dan Ives' voice is one of conviction and optimism, and it's worth listening to, but as always, you need to do your homework and match names with execution. Thanks for tuning in. If you like this breakdown, hit the like button, subscribe for more tech stock and AI market commentary, and leave a comment below which company in that interview are you most bullish on: Meta, Microsoft, Apple, or another. Before we dive into the two great tech stocks to consider buying right now, this video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Alright, let's start with the first tech giant on our list. We're talking about Advanced Micro Devices, ticker symbol AMD. Advanced Micro Devices has built a reputation as one of the most innovative semiconductor companies on the planet. They went from underdog to top-tier competitor against the biggest names in chips. Over the past few years, AMD has reshaped its business around high-performance computing, powering everything from gaming consoles and PCs to cloud servers and now artificial intelligence systems. The company's turnaround under CEO Lisa Su is one of the best corporate comebacks in recent memory. She steered AMD away from the brink into a new era of profitability and technological relevance. Today, AMD's data center business, driven by EPYC processors, is one of its biggest growth engines. Those chips are being adopted by major cloud players like Amazon Web Services, Microsoft Azure and Google Cloud, and that adoption matters because hyperscale customers are very picky about performance, power efficiency, and total cost of ownership. AMD's next frontier is AI acceleration. The MI300 series chips are designed to compete with other high-performance accelerators in the exploding AI data center market. Analysts expect AI computing demand to grow exponentially over the coming years, and AMD is positioning to take a meaningful slice of that market. Early technical reviews and initial customer feedback indicate the MI300 platform is a serious contender, offering both strong performance and energy efficiency. Those two traits are crucial for large data centers that want to scale AI workloads without exploding their power bills. But AMD is not a one-trick pony. Its diversification is a major strength. The gaming segment, which includes custom processors for PlayStation and Xbox, continues to deliver stable, high-margin revenue. The acquisition of Xilinx opened the door to embedded markets such as automotive, industrial automation, and aerospace, where long product life cycles and higher ASPs can support sustained profitability. Advanced Micro Devices came into the conversation with a market cap of $41.21 billion, reporting earnings per share of -$0.08, revenue of $25.78 billion in 2024, and net income of $1.64 billion. In Q3, the company beat expectations, delivering an EPS beat of 10% and revenue ahead by 5.7%, Yet the stock still slid about 9% after the report as worries about lofty tech valuations and a softer market weighed on sentiment. Despite that pullback, analysts remain constructive, modeling roughly a 38% revenue increase for 2026, and the underlying growth metrics are compelling. The P/E multiple eased a bit from 82.28 times in Q2 of 2025 to 78.28 times in Q3 of 2025, suggesting the name is becoming marginally more affordable. Revenue growth accelerated to 31.83% in Q3, free cash flow growth exploded to 392.76%, and profitability shows steady improvement with gross margins at 48.26%, and operating margins at 8.78%. Taken together, these numbers paint a picture of a company generating strong cash and improving efficiency, even as the market debates how to price its future AI and data center upside. On the financial side, AMD has managed to maintain healthy gross margins while navigating semiconductor cycles. Cash flow generation is solid, and management continues to pour resources into R&D to protect their technology lead. Investors who worry about cyclicality should focus on AMD's secular exposure to AI and cloud infrastructure. If those markets expand as expected, AMD stands to benefit disproportionately because of its product roadmap and relationships with cloud hyperscalers. Competition is real. NVIDIA remains the dominant player in AI accelerators, and Intel is trying to regain ground on multiple fronts. But AMD has repeatedly shown it can execute, take market share, and innovate at scale. For investors who believe AI and high-performance computing are the core growth stories for the next decade, AMD is a compelling long-term play. Now let us shift gears from microchips to robots. The second company is Symbotic, SYM. Symbotic is quietly automating the backbone of retail logistics, and the impact could be massive. The company designs and deploys AI-powered robotic systems that transform how warehouses operate. Imagine fleets of autonomous robots sorting, stacking, and retrieving items with speed and accuracy that far exceeds human labor. That vision is not hypothetical. Symbotic is delivering systems to some of the biggest retailers in the world. Its technology has attracted heavy hitters. Major retailers including Walmart, Target, and Albertsons are deploying Symbotic systems to modernize distribution centers and improve throughput. Walmart, in particular, has been a notable partner and investor, deploying systems across dozens of distribution centers and backing Symbotic with a meaningful equity stake. That kind of strategic customer relationship is more than a commercial win. It is validation that the technology can scale in real-world, mission-critical environments. What makes Symbotic unique is the integration of hardware and software. Their platform combines machine vision, advanced AI algorithms, and robotic hardware into an end-to-end system. That means Symbotic controls the entire stack from sensing to motion to orchestration. The result is automation that not only speeds up processes, but also dramatically reduces error rates and optimizes space utilization. For large retailers, those efficiency gains translate into millions in cost savings, faster order fulfillment, and better inventory accuracy. Symbotic is growing fast. Revenue growth has been impressive as more warehouses come online and long-term service contracts ramp. The company is still investing heavily to scale operations, expand installation capacity, and support customers through implementation and maintenance. That means short-term profitability is limited, but the revenue runway and recurring service revenue model point toward attractive long-term margins as deployments mature. The addressable market here is enormous. Warehouse automation and robotics for distribution could be a multi-hundred-billion-dollar market globally as e-commerce and rapid fulfillment become the norm. Retailers are under intense pressure to reduce costs and speed delivery, and automation is the most durable solution. Symbotic sits squarely at the intersection of that structural trend and real-world demand. There are risks to consider. Symbotic is still in growth mode, and scaling manufacturing and service delivery is operationally complex. Competition from other automation vendors and in-house solutions from large retailers is also a factor, but the company's deep integration with leading retailers and the proven economics of many deployments give it an edge. For investors who can tolerate early-stage volatility, Symbotic offers exposure to a technological shift that changes how goods flow from factories to consumers. Symbotic carries a market cap of $15.11 billion and reported an EPS of negative $0.19, with revenue at $1.78 billion in 2024 and a net loss of $13.49 million. Investors have been gravitating to the name recently, pushing a roughly 13.4% return over the past month, and the earnings outlook shows a dramatic rebound with projected EPS growth of around 400% year-over-year, alongside a robust revenue growth forecast for the fiscal year. That combination of a near-term turnaround in profitability expectations and meaningful top-line momentum is what is driving interest. But as with any recovery story, the key will be execution and confirmation of those upgraded estimates in upcoming quarters. Between AMD building the brains of the AI revolution and Symbotic powering the physical infrastructure behind global commerce, both companies sit where innovation meets long-term economic growth. If you are serious about finding high-potential opportunities like these, check out the Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid companies but do not know where to start, I created the Value Stocks Investing Master Course to teach you how to identify great businesses, make smart decisions, and build a portfolio that lasts. Click the link in the description or the pinned comments to get the course today and take control of your financial future. Let us recap. AMD represents the digital backbone. It powers data centers, AI models, and gaming consoles. It is profitable, has a proven track record, and keeps pushing chip performance higher. The real upside is tied to adoption of AI accelerators and continued share gains in cloud infrastructure. Symbotic represents the physical frontier. It automates logistics and warehouse systems with AI-driven robotics that are being adopted by some of the largest retailers in the world. It is a growth stage company with transformative technology and a long runway as automation becomes the standard across distribution networks. Both companies tap into megatrends that are reshaping the global economy. Artificial intelligence, automation, and efficiency. Both could offer significant upside for investors who think long-term and can handle volatility along the way. Now I want to hear from you. Which of these two tech innovators do you think has the stronger long-term potential? Do you believe AMD's push into AI acceleration will take market share from incumbents, or do you think Symbotic will revolutionize logistics fast enough to justify its growth expectations? Drop your answer in the comments and explain why you chose that company. I read every response. If you want exclusive stock tips, deeper analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon and take your investing game to the next level. Our members get full in-depth research on many of the stocks we talk about here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. The link is in the description. Do not forget to like this video, share your thoughts in the comments, and subscribe to the channel so you do not miss out on the next important financial investing update. Thanks for watching, and I will see you in the next one.